Hello everyone, this is Brandy Williams with an educational accounting and tax video. Please like, share, and subscribe to my YouTube channel. You may also follow me on Instagram, Facebook, and TikTok at Williams Act Tax. On LinkedIn, connect with me by searching Brandy C. Williams Mac. Lastly, visit my website, williamsacttax.com, to review my bio, read my blog, enroll in tax school, contact me, and schedule a free consultation. I look forward to hearing from you. Enjoy the video.
So, what is captive insurance? Many small business owners are unaware of the simple methods for lowering their taxes and expenses. By forming a captive insurance company or sharing, they can decrease their tax by a certain percentage. It has been noted that almost 80 of Fortune 500 companies employ this strategy and obtain some form of captive insurance arrangement when they think that outside insurance carriers are raising prices or they are unable to obtain the coverage they demand. They establish their own insurance companies. You can choose to finance the cost of your insurance coverage yourself thanks to a captive option created by the parent insurance company. When you purchase insurance from a company, you pay money for their service, but that money is lost forever. However, when you invest in captive insurance, you have a good possibility of getting your money back. So, what is captive insurance? A captive insurance company is a special purpose legal organization with an insurance license that was formed primarily to cover a portion of the risks of its sponsor, which is typically a corporate parent, group, or association. In a captive, the insured owns the insurance company, which is a different risk management method. In turn, the captive insures part or all of the risks posed by its parent firm and any affiliated organizations. A captive often insures risks that are either prohibitively expensive to insure or extremely challenging to cover in the commercial insurance market. The main purpose of this is to avoid patronizing traditional commercial insurance companies, which have variable pricing and may not satisfy the company's specific needs. The parent company can lower costs, insure complex risks, gain direct access to reinsurance markets, improve cash flow by starting its own insurance company. When a company forms a captive, it can indirectly assess the risks of its subsidiaries, write policies, determine premiums, and then either return any unused funds in the form of profits, invest them in order to pay out claims in the future. Captive versus traditional insurance. If your company has accumulated some cash reserves and you're sick of seeing your insurance costs rise, you might want to think about captive insurance. Captive is a type of self-insurance as opposed to traditional insurance, which is obtained through a third-party insurer. In this scenario, your company establishes a subsidiary of itself that writes and pays for its own insurance coverage. Captive insurance is created to manage risks and maximize profits. For instance, compared to the premiums paid to a traditional property and casualty insurance company, a company can significantly reduce insurance expenses by setting up a captive insurance company. Creating one's own insurance vehicle can result in large cost savings in the form of underwriting profits, which the captive company's owner can keep. These costs include overhead, marketing, agent commissions, advertising, etc. A captive insurance company can also offer protection against risks that turn out to be prohibitively expensive or even inaccessible in commercial markets. Another reason why business owners might decide to create a captive insurance firm is the inability to obtain specific types of coverage from commercial third-party insurers. A business owner can manage their self-insured risks with a captive insurance firm by making tax-deductible premium payments to their captive insurer. To the level that the captive earns profits, those profits belong to the captive's owner. In general, a captive insurance firm can provide greater benefits to your operating company than a commercial insurance company. Its advantages: savings on premiums and taxes are possible. Long-term financial investment, perfect for large, medium, and small businesses. Risk distribution is provided. Captive insurance tax benefits. A properly established and managed captive insurance company may offer the following tax and non-tax advantages. Insurance premiums paid to the captive are tax deductible for the parent firm. Other tax benefits include gift and estate tax savings for shareholders, as well as income tax reductions for both the captive and the parent. Possibility of accumulating wealth in a tax-favored vehicle. distributions to captive owners at low income tax rates. To form a captive insurance company, capitalization requirements and required formation fees, including legal fees, must be met. This is because the captive insurance firm is a legally created corporation. With captive insurance, you are relying on your risk mitigation measures and controls to finance future losses and maintain such profitability that would typically wind up in a traditional insurance company. This requires adequate capital to offset potential losses. To diversify risk further, your captive firm can work with a reinsurer to pool your premiums with those of other captive insurers, perhaps lessening some of these risks. Traditional insurance? Traditional insurance transfers risk to a third-party company for a fee and a deductible. Traditional insurance firms analyze the probability of risk based on the broad pool of risks they insure, which then determines the premium cost for your insurance company. Unless a claim is filed, the premiums paid to the traditional insurer are not reimbursed to the insured. Furthermore, the traditional insurer will need the insured to pay their deductible out of pocket, and your subsequent year's premium will increase owing to the loss and increased perceived risk. One advantage of traditional insurance is the ease with which it can be obtained by contacting an insurance agency. Traditional insurance has its advantages: low initial costs, tax deduction for premium payments, risk dispersion, easy to set up. Traditional insurance tax benefits. Traditional insurance comes with a variety of tax benefits, such as the following. Any profits generated in the cash value of your insurance policy increase tax-free. Monthly withdrawals may be tax-free in some coverages. Transfers between the underlying investment alternatives of a variable life insurance policy are normally exempt from both current income and capital gains taxes. Traditional insurance involves a third-party insurance provider taking on your risk. Based on your company's risk factors, they are betting against having to pay out a claim. Your company pays an annual premium, and the typical insurance company is profitable because there are no claims. Furthermore, the business owner faces the annual risks of claim denial, expensive rate increases, and her capacity issues. This means that premiums will be higher and that all premiums and deductibles will be sunk costs.
This is Brandy Williams. I hope you enjoyed the video. Please like, share, and subscribe to the channel, and follow us on all social media platforms.